scooping up after had last week. Shares up almost 4%. Scott?
All right, Christina, thank you. Christina Partsenevelos. We have some news out of the CFTC. Contessa Brewer joining us now on the news line with the headlines. Contessa?
Yeah, Scott, the Commodities Futures Trading Commission, this is the federal agency that oversees not only commodities trading, but the predictions markets, has thrown in the towel in its opposition over elections prediction trades or elections bets. You might remember that Kalshi had sued the CFTC to allow these election trades to go forward. A federal court before the election last November said that they could continue to accept those trades while the court deliberated. And today the CFTC has said it will no longer appeal this. This is a big move in favor of Kalshi. It has had a series of legal wins, not just over election trades, but also sports trades as well. New Jersey, a court just in New Jersey had handed Kalshi a win that allows Kalshi to continue to offer trades on sports. And this is a real game shifter in the landscape for wagering, because what it does is it opens the door to these sort of predictions markets or bets in all 50 states, where if you look at sports, Scott, it's only legal in 39 states right now. The biggest, California, Texas, don't allow any kind of sports betting. In Florida, Hard Rock and the Seminole Tribe has the monopoly, and the big commercial operators like FanDuel and DraftKings don't get a chance to operate now. This creates a whole new playing field and opportunities, not only for the likes of Kalshi and interactive brokers, but potentially even new players or sports books to come in and offer predictions trades.
Interesting. We'll follow it. Contessa, thanks for the headline. That's Contessa Brewer. We're just getting started here on Closing Bell. Coming up next, Intelligent Alpha's Doug Clinton. He's standing by with what he'll be watching for when Palantir reports today in OT. He'll join us after the break.
I come up, what's the deal?
We're back with a news alert on drug manufacturing. Angelica Peebles joins us now with those details. Angelica?
Hey, Scott, the Washington Post is reporting that President Trump will sign an executive order today to incentivize domestic drug manufacturing. That's according to White House officials who are speaking on background. And a few of the different policies that will supposedly be in this executive order are directing the FDA to reduce the amount of time it takes to approve pharmaceutical manufacturing plants in the U.S., as well as directing the EPA to accelerate the construction of facilities related to manufacturing of drugs and their ingredients. Now, these are both important components because we've heard from some of the CEOs, companies like Eli Lilly that's building many manufacturing plants in the U.S., that it can take years to get these things built and permitted. And that's one hurdle. So, of course, that's a big step for these companies. So we'll have to see exactly how that plays out and if this does, in fact, incentivize more manufacturing in the U.S. Scott?
Angelica, thank you for the update. Angelica Peebles. Tech investors get another read on the AI trade today when Palantir reports earnings in overtime. Here to discuss is Intelligent Alpha founder and CEO Doug Clinton. Welcome back. It's nice to see you.
Good to see you, Scott.
This has to be the ultimate stock to give you a barometer of momentum in the market. When momentum rolled as a factor, this stock led the way. When the markets come back, this stock's done unbelievably well. So what does that mean for tonight?
Well, I mean, to your point, Scott, up 60% in the last month are Palantir shares. So, I mean, I think the reality is the bar has to be pretty high. You know, you look at the price action of the stock coming in, and whenever you're up 60% in the last month, I think that says that you have to really not only beat expectations, but beat them handily. And that's what Palantir has sort of been doing the last few quarters. It's not a stock that we own at Intelligent Alpha. The challenge for us is not that it's not a great business, because I do think it is. The challenge, though, is you look at it fundamentally, trades at 70 plus times revenue. And I think it's just hard to see how do you get a long-term return if you're not just trying to trade it.
What do you think we learned last week about the AI trade in general? And I ask you that in the context of what Brad Gerstner of Altimeter told me a little bit earlier today about where he thinks we are. I'd like you to listen to that and then give me your own answer.
We're just getting started. We're in the first inning. This is 2000 to 2003 internet time here. And what we heard over the last few weeks is all of the biggest companies in America continue to double down on their investments in AI, and they're seeing the paybacks.
First inning. You agree?
I might have said second inning. I would say, though, I hope we're not in the 2000 era. He mentioned that. That wasn't a great year for the internet trade. I think we're more like 1994, 1995. So I would agree with Brad that it is still early. And to your question, what we learned last week from the mega cap tech stocks, we learned that despite this consistent narrative that eventually things have to slow down, the hyperscalers are not slowing down. We're hearing consistent commentary. Amazon talking about as soon as they put infrastructure in the ground, it's already at capacity. Meta talking about new products that they're building on AI, including hardware. And Microsoft, the one that we keep kind of hearing these rumors about, maybe they're going to cut CapEx. They reiterated their numbers too. So I think the trade certainly fundamentally is intact, but I think that the excitement from the investor community has still not yet come back.
Your implication, though, is that if you're as early as you suggest in terms of those years, that it eventually ends badly, because that's what it did. I feel like his was more, we're on the other side of some crazy, and now we've really focused on the best and the brightest, the NVIDIAs, the Microsofts, the Metas, the Alphabets, the Amazons, right? We're not so much paying attention to the throw AI in your name stocks. We've actually weeded some out.
We have a little bit, but again, if you're early, I think definitionally you also have to believe that at some point it does get crazy. Because if you're not early and it doesn't get crazy, then this AI boom that we're talking about may ultimately be disappointing. Logically, as you look back throughout history and the flows of capital into these new emerging technologies, the reason that we kind of get to crazy, the reason that we get to these bubble levels is because you need a lot of capital to come in and make sure that all crazy ideas get tried, because some of them end up being really good, and also to reduce the cost of the technology for widespread adoption. And so I would say I think we're still very early. I think we probably do get to some sort of crazy level, and we're still several years from that happening.
We'll leave it there. I've got some more news I have to get to. Doug, thanks. We'll see you soon. That's Doug Clinton joining us here on Closing Bell. Sticking with the AI trade. In the last hour, OpenAI announcing an updated plan for its structure. Kate Rooney joins us with the details. Hi, Kate.
Hi, Scott. So OpenAI giving us an update on its restructuring plan. This is in light of some pushback from civic leaders and ex-employees around safety concerns. So OpenAI is going to be pivoting from prior plans it's talked about to spin out the nonprofit and then create a separate full-profit company. This is a $300 billion company, one of the most valuable in the world at this point in terms of private markets, saying today it's going to continue to be controlled by that original nonprofit. It's going to retain a large ownership stake as well. Chairman of the board, Brett Taylor, and CEO Sam Altman today saying this decision was made after hearing from civic leaders and then engaging in what they called constructive dialogue with the attorneys general of Delaware and California. On a call with reporters, executives did push back on the idea that this was in any way a response to Elon Musk's attempts to block this restructuring. He was also a founder of this company, Brett Taylor, saying the only basis for the decision was to set up OpenAI for the future. Altman, for his part, telling us this does not change any sort of investor plans, including SoftBank, which had a clause in its last investment, and saying that if it didn't restructure, if this company didn't restructure fully by the end of this year, it could actually lower that amount. Altman's saying that's not the case. Investors are on board here, Scott.
All right, Kate, thank you. Kate Rooney up next. CNBC unveiling its ranking of the world's most valuable soccer clubs. We'll discuss coming up when the bell comes right back. Welcome back. CNBC unveiled its rankings of the world's most valuable soccer teams today. Average team now worth $2.76 billion. That's far below the NFL and NBA averages, but on par with baseball valuations. The most valuable team on this year's list, Real Madrid, worth $6.7 billion, followed by Manchester United, Barcelona, Liverpool, and Manchester City. Joining us now is Michael Ozanian, the man behind the list and CNBC senior sports reporter. It's good to have you here.
Great to be here.
Should I be surprised that Real Madrid is number one and not a Premier League team, that it's somebody from La Liga, or no?
No, I wouldn't be surprised because unlike in the U.S., Scott, where you and I have talked about in the past, we mentioned the NFL, the money is split evenly with broadcasting deals between every team. Doesn't matter if you go 17-0 or 0-17. In European soccer, a lot has to do with how well you do on the pitch. So you talk about Real Madrid, they regularly either win La Liga or certainly near the top, and they have the record number of Champions League wins in all of football, which is what they call it over in Europe. I think 14 or 15 times they've won it, and that could give you that. Winning first in Champions League could bring in another 150, 160 million in revenue. So they also have the new stadium there. Stadium economics are great for them. They doubled their match day revenue last season.
Okay, so I look at the list now. When you're telling me that how you do on the pitch actually matters to where you go in the Ozanian rankings, Man U, they're terrible now.
Yeah.
But yet they still have the cachet of this incredibly powerful global brand that gives them the valuation that you put on it?
Yeah, but I wasn't that kind to him, Scott, because I valued him at $6 billion, which is less than the valuation when Ratcliffe bought his stake. They're going to miss out on the Champions League next year, so we've knocked them down a peg from the most recent investment.
I thought maybe you're going to have Arsenal, Stan Kroenke's team, up there. Big stadium, they do well. By the way, they ousted Real Madrid from the Champions League most recently. Rabid fan base. I mean, they seem to have all the economics in place to be high on the list. They don't even make the top 6 or 7 of what you have.
But they've done very well since Kroenke made the investment. And to your point, the Champions League, you're going to see their revenue go up significantly this year. And you're also going to probably see their value go up. But their fan base in general, as a global brand, is not as big as Manchester United.
Some questions as to whether Man U is going to get relegated this year. I mean, that's how
not that bad.
Been tough. Well, it's been tough. Man U fans, you know what I'm talking about. Mike, thanks. Mike Ozanian. For the full list of global soccer team valuations, you can head to cnbc.com/sport or scan the QR code right there on your screen. Up next, we track the biggest movers into this close. Pippa Stevens is standing by with that. Hey, Pippa.
Hey, Scott. One staple stock is moving lower after earnings. We've got the name to watch coming up next.
AI meeting agent.
All right, we're 15 from the bell. Let's get back to Pippa now for the stocks that she is watching. Tell us what you see.
Well, Tyson Foods is in the red after earnings disappointed the street as record high cattle prices pressured results, and with the company just reiterating its outlook thanks to ongoing tariff uncertainty. While the chicken and pork segments held up fine, CEO Donnie King said beef is, quote, experiencing the most challenging market conditions we have ever seen. And Sunoco down 6% after announcing it will buy Canadian rival Parkland for $9.1 billion, including debt. The acquisition will expand Sunoco's geographic footprint as well as its network of retail locations. Scott?
All right, Pippa, thank you. That's Pippa Stevens. Still ahead, we'll tell you what to watch for when Ford reports in overtime. We are back on the bell right after this break. A programming note for you. Don't miss an exclusive interview with NVIDIA CEO Jensen Huang and ServiceNow CEO Bill McDermott live from ServiceNow's Knowledge 2025 conference. It's out in Las Vegas. It is tomorrow, and it's on Power Lunch. Up next, I'll tell you what to watch for when Mattel and Ford report their earnings in overtime tonight. The Market Zone's coming up next. We're now in the Closing Bell Market Zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. We have two earnings reports we're watching in OT. Courtney Reagan on Mattel, Phil LeBeau on Ford. Mike, I'll begin with you. Probably lose the 9-day streak today, barring something dramatic in the last 5 minutes or so, but it's been a great run. Today's just about kind of treading water a little bit.
Mostly, yeah. Also interesting, about half the S&P decline, the net decline, is Berkshire Hathaway and Apple on the Monday after
Forever linked.
Warren Buffett handing it up. Yeah, I don't even know if you wanted to root for a 10th straight up day. I look back, the last time you were up 10 or more was in July of 2023, and when it ended, you almost went into a 10% correction immediately. So it's not to say that streaks are bad. It's just that when they stall out beyond extremes, it means you're not getting too stretched. I do think that in general, up 3% last week in the S&P, up 17% off the low, like you've been saying, it creates for, at best, a more balanced tactical view. Just because it seems like you need to have more obvious incremental positives to get up from here toward the old highs, rather than just excessive negative positioning and worst case scenarios running through everybody's head.
All right, Courtney Reagan, there was a lot of talk this weekend about dolls and how many we should have. have? Well, today with Mattel, we're going to find out perhaps how many toys we can actually get given the trade war.
You took the words right out of my mouth, Scott. I mean, analysts are estimating that Mattel will report $786 million in revenue with a loss of 10 cents per share, adjusted gross margin of 47.9%. But as you say, investors really are going to be focused on any commentary from Mattel, of course, the maker of Barbie, an American Girl, about its tariff mitigation plan, especially after those comments from President Trump saying children maybe just need to be okay with $2 instead of 30. I think Mattel would beg to differ. Well, Jefferies estimates about 22% of Mattel's revenue and cost of goods sold are exposed to U.S. tariffs on Chinese imported goods, compared to 17% of Hasbro's. Now, Mattel is coming off its worst month since March of 2020, down about 8% this year. Hasbro up about 11% year to date, so pretty divergent performance there. Now, Mattel has said it plans to close a production facility in China in 2025. But I think in light of the news that came out on April 2nd and the iteration since then, investors still have a lot more questions going forward.
Thanks, Courtney Reagan. Phil LeBeau, I mean, so many twists and turns around autos, obviously. I guess good time to hear from Jim Farley about what he thinks, pull forward demand, all the above.
Oh, yeah. And look, when you look at Ford's results when they come in just a few minutes, it's clear that it's less about the first quarter, as it really has been for all the automakers. It's really what's going to happen from here. So what's the tariff impact? That's going to be the primary question that come out of the Ford earnings results, not just for the second quarter, but for 2025. Will they adjust production? Are they going to further curtail their EV plans? In terms of profit and loss, the estimate is essentially for a 2-cent profit. That's what the street is expecting for the first quarter. For the full year, and let's see if they keep the guidance, they're expected to earn $1.10. Don't forget, tomorrow morning, first on CNBC on Squawk Box, you do not want to miss what Jim Farley has to say. He's been pretty candid about his thoughts on what's happening with the tariffs. We'll see what he has to say tomorrow morning. Scott, numbers in a few minutes.
Look forward to that, Phil. Thank you. That's Phil LeBeau. I mean, some of these, Mike, meat and potatoes tariff stocks. I mean, the ones that really are in the center of the storm, like Ford and some of the other OEMs.
They're in this limbo, this extreme version of limbo here, where nobody is going to be able to really project ahead to exactly what it's all going to mean. But it feels as if we at least have to be alert to the possibility that they get some relief from here. I do think that's one of the reasons the market is trading this way. Everybody knew Treasury Secretary Bassett was going to be speaking today. Maybe there'd be an actual deal as opposed to just a promised one. So that's the dynamic we're in right now. You know, the jobs report on Friday probably came as a little bit of an upside surprise to the psychology, but in itself, in an objective basis, if you look at the cyclical indicators within it, it was kind of treading water. I mean, that's kind of what we're doing. We've decelerated. We're definitely not completely kind of in an absolute downtrend, but we're suspended at this moment of it's fine if it stays this way, but if we actually get the tariffs imposed, we have to reevaluate.
I think treading water was okay. I mean, there was some fear that we'd be sinking, right? And we're treading.
It's for sure. And the credit markets have affirmed that. They've improved in the last few weeks as well.
Palantir tonight as well. Important gauge. Stocks up. It's been a rocket ship, 60% a month or something like that.
And to me, that's one reflective of the fact that the retail trader.
Can you see my entries now, Riley? Shit. This platform is acting up now. Here, can you see the entries? Shit. This platform. Oh, I see. I mean, the thing is, it usually shows. It shows when I enter, you know. Here, let me just, here. I'm gonna go long here. See this? This means I'm gonna go along. Let me just scalp this. This is where I exit. But it should go lower, actually. Damn heartburn. Probably go down to roughly 220, maybe. Let me just get out of this. And just layer your entries. No, I just I mean, I've been to Grand Canyon. That's about it. I mean, not really much in Arizona. Whereabouts in Arizona are you? No, it didn't film me, see? It did not film me. Let's try again. See, I'm in a trade right now. And I'm gonna add right there, see? In and out. That was the entry. See, the exit is a red triangle, so it doesn't show in a red like this. Lake Havasu. Yeah, never been to Lake Havasu. I heard it's nice. Yeah, I heard it's nice. Because here in Vegas, we got the Lake Mead, which is so-so, not really. But I heard that Lake Havasu is a lot better. But never been there. Yeah, yeah. I heard Phoenix is even hotter than Vegas. Yeah. So it's the same kind of weather. But yeah, I mean 122, that's the kind of weather we get down in Laughlin. It's like a hair dryer effect. It's so hot. You walk outside, it just hits you like this heat. Yeah, it's crazy. Yeah, anything over like 115, 117, it's becoming too much. You got to be like in the water or indoors, just cooling off a little bit, because it's just, I mean, 120 and up is just, I don't know. We can get probably heat stroke easily, you know. So got to be careful. Yeah, I would. If you're gonna move, I'll be moving probably. I would move like spring or fall, even winter time. But man, during the summertime, forget it. It's crazy. Yeah, it's. What do you do for work? All right, Riley. Have fun at work. What kind of work you do, if you don't mind saying it? Wash cars. Hmm. What, a car wash? Oh, okay, okay. Yeah. Yeah, I'm gonna end the stream here anyways. I got lots to do, phone calls to make, so I'll see you guys probably tomorrow morning. New York Open, New York session.
on pharmacy. Guys, I'll be talking with the CEO and CFO in a few minutes to bring you highlights from that conversation, perhaps about that lowered Q2 guidance and that adjusted guidance going forward for the fiscal year.
All right. Brandon Gomez, thank you. We're going to keep with the panel for another moment. Kevin, the China factor here, arguably helping Palantir because it is key to that sort of AI, military, industrial, like software surge response, but hurting Mattel. And China's global response just starting to take shape, it seems. We've heard them sort of discourage others from trying to isolate according to the U.S. plan. What do you expect to see from them over the next several weeks? How might it affect the markets?
Well, in terms of China. Yeah, I think that the response mechanism is so different this time versus the first trade war, if you want to think about it that way, the 2018 to 2019 period, especially because over the several years that you've had since the first Trump administration, the broader bloc of Southeast Asia, in terms of its relationship with China, has strengthened in terms of trade. Whether it's because things have been rerouted through those countries to the U.S. or whether there's just been more direct trading between China and those countries, I think it probably benefits China this time relative to where the position they were in the first trade war. It's not like it's a massive benefit because they're still hurting, both countries are still hurting in terms of the U.S. and China if tariff rates stay this high. But I think that that's an important thing to consider in this. You talk about Chinese demand for other products or other services. It's not, it's feasible to think that that's the case. That could be the case moving forward where they can sort of act as their own source of demand. They don't necessarily need the United States. But of course, relationships are a lot more complex than just that. But I think it's an important factor to consider because a lot of dynamics around the world and global trade have definitely changed. Some for the better, some for the worse, but that's an important differentiator, especially because, this current disruption is not just two countries going at it. It's not just U.S. v. China. It's U.S. with basically the rest of the world and trying to figure out, through various negotiations, trying to figure out what percentages make the most sense from a tariff standpoint.
And we've seen this across all asset classes, including just today. Major volatility in the Asian currencies versus the U.S. dollar, too. That was the other big story.
Yeah.
Binge boy, sugar futures? No. Let me take a look here. Hold on a second. What's the symbol? Orange man shooting from the hip. Of course he is. He's a maniac. He's a manipulator. This whole tariff thing was just a big manipulation of the markets. Drop the prices, have the big boys buy up all the at low prices, and just it's crazy. What sugar? SBN?
Welcome back to Overtime. Clorox earnings are out. The stock is trading lower. Steve Kovac has the numbers. Steve?
Yeah, John, that's due to misses on the top of bottom lines and a tariff warning in here for guidance. First, let's go over EPS. That came in at $1.45 adjusted. Street was looking for $1.57. Revenues, a miss as well, $1.67 billion. Street wanted $1.73 billion. And then they're lowering their guidance here. Clorox lowering their guidance for the current quarter, also wrapping out their end of their fiscal year due to tariffs and macroeconomic uncertainty.
You're going to smoke a blunt? Nintendo. Oh, man.
Impacting Clorox future sales for this quarter. And then margins, though, did come in above expected. Gross margin was 46%. Street was looking for 44%. You see stock off 3% now.
Hey, Binge Boy. So when you smoke, do you play better on Nintendo? Or is your performance better or worse?
The only negative impact we see in our business is continental Europe's unwillingness to buy the best product as defined by what's succeeding in the most dynamic market, the U.S., and that is an ongoing trend. In fact, he has been talking about it, honestly, for years now. There's a lot of theory in the market, he says, quote unquote, but when the rubber hits the road, it's value creation when it really matters. And to get to 71% growth in the U.S., that's for commercial, and the 83 rule of 40, you see that we are downstream from very significant value creation. Well, joining us now is Jefferies' Brent Thill and Wedbush's Dan Ives with opposing ratings on the stock. Brent has an underperform and Dan has an outperform. So this is a good old-fashioned bull-bear discussion here. Dan, you're on set. I'm going to start this conversation with you. Your reaction to the commentary from Karp, who basically said to me, look, macro uncertainty, if you can deliver value in this market, people are still going to spend, companies are still going to spend, governments are still going to spend, and they're seeing that in their results.
I mean, look at those numbers. I think you could print this press release off, frame it, and put it in the Louvre, because if you look at the numbers, you look at commercial, you look what, in terms of AI, they are leading when it comes to AI revolution. The software numbers are showing, even on the government side. And look, if you look at the bears, they hate it at 30. Despise it at 50. Absolutely say it's expensive at 100, 125. Look, I believe this is going to a $1 trillion market cap in the next 2 to 3 years. These numbers just show. I think it's get the popcorn out. It's still in the early days of playing out.
Brent, want to get your thoughts on this, especially since you have a price target that is markedly lower than where the stock is trading right now, basically half of where it's trading right now.
And Dan's price target's lower than his bullish view.
That's true.
Look, I think when you think about the fundamentals are alive, right? They beat by 24 million. They raised the guidance by 6 times the beat. We're not arguing the fundamentals. They are fully alive. The question becomes, there's not a single software stock that we've ever covered that trades at this multiple and sustained it. Snowflake, Datadog, you go through the list. So it's largely just history and valuation lessons, which haven't worked for any of these names. And so we watched Snowflake go to 50 times revenue and then went to 8 times revenue. And so Palantir is in a different league. There's no question the fundamentals are delivering. It's just the question, what is the stock worth? And our job is to find names where we don't feel like there's downward pressure on multiples, there's upward pressure. So Microsoft, AppLovin, there's a handful of other names that Jefferies covers that we're recommending that we just feel are great franchises and have better durability at multiples that aren't at 65 times revenue. There's not a single tech name that's ever sustained that multiple.
Dan, I hear what Brent is saying, but in a world where NVIDIA and Tesla have done what they've done recently, does history have that much bearing if you believe, as you seem to, that Palantir is this generational opportunity?
Well, I think, but look, I mean, the value, if you go back the last few years, right? I mean, they hated it at 10, despised it at 100, and that would be the continued argument on valuation. If you look what's happened in the AI revolution, $2 trillion of spend over the next 3 years on the software side. It's their world. Everyone else paying rent, and it comes Palantir. So my view is, if you look at it just on valuation, and if you went back, you've missed every transformational tech stock the last 20 years. If you just focus on valuation, where is this in the next 2, 3, 4, 5 years? And I view what Karp's doing at Palantir is generational. But again, the haters are going to hate. I get it. Valuation, check the box. You look at these numbers, To me, I think this is just another sort of table pounder moment, for what I view as the Messi of AI, Palantir.
So, Brent, what breaks Palantir then in the amazing run that it's been having? Is it overall sentiment? And if it's an overall sentiment issue, how many other things have to break at the same time?
I think ultimately you hit a point which you've hit on the multiple. I mean, look at the numbers and the stock's down 5% in the after hours. There's some break point where, investors, this has been fueled by retail. There's not a single institutional investor I talk to that even talks about this name.
And that's part of the problem.
It's a retail driven story, and it's not being driven by institutions. Our investor base is institutions. And so the reason why I spend such little time is no one can make sense of the multiple. And so I spend my time on things that have multiple support. So again, I'm a huge fan of the fundamentals. I'm not going to argue, and I think Dan's had a great call. So kudos to him, and no one's going to take that away. It's just my view is I think there are just other stories that we have more confidence in with that valuation support.
Dan, I'm going to let you respond to this.
No, I'd say Brett brings a really important point because retail has been way ahead of institutional and Palantir. And Palantir, again, they continue to hate it. And they'll continue to hate it when I believe it's up another 40, 50, 60%. Part of the problem here is that institutional, they paint it with a certain brush. They have a certain negative view. And I agree with what Brent's saying. I think institutional has been way wrong on this. Retail has been right. But I do believe institutional eventually, just given, from a weighting perspective, you can't just continue to hate what I view is going to be $1 trillion market cap.
To be fair, Alex Karp has a very negative view of institutional, too.
And that hasn't helped.
Dan, Brent, thanks to you both. Good debate. Well, still ahead, stocks making a full round trip since the tariff announcement, but is sentiment now getting stretched? We're going to talk to Piper Sandler's chief investment strategist about one thing he says needs to happen to keep this comeback rally going.
And we've got much more ahead on today's after hours action with right across the screen, including a closer look at Mattel and how tariffs could take the fun out of the toy business. Overtime, we'll be right back.